How do options market bid-ask spreads differ from stocks? Have you ever wondered why the bid-ask spread for options is often wider than that for stocks? Understanding this difference can really help you navigate the world of trading. Let's break it down step by step. First, let's clarify what a bid-ask spread is. The bid-ask spread is the gap between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept for a security. This spread is a key indicator of how easily you can buy or sell a security in the market. Now, when we look at stocks, the bid-ask spread is usually narrower. This is because stocks are more liquid, meaning there are more buyers and sellers actively trading them. For example, if a stock has a bid price of $50 and an ask price of $50.10, the bid-ask spread is just 10 cents. This small spread shows that the stock is actively traded, making it easier for you to buy or sell at a good price. On the flip side, options typically have wider bid-ask spreads. Several factors contribute to this difference. First, options are generally less liquid than stocks. This means there are fewer buyers and sellers for many options contracts, especially those that are not very popular. When liquidity is lower, the bid-ask spread tends to widen. Next, options are more sensitive to market volatility. When the market is volatile, market makers may widen the spread to manage their risk. This means that during times of high volatility, you might see larger gaps between the bid and ask prices for options. Another factor is the time value of options. Options have a time component, and their value decreases as they approach their expiration date. This time decay can also lead to wider bid-ask spreads, particularly for options that are nearing expiration. Additionally, options contracts are very specific. Each contract has different strike prices and expiration dates. This specificity can reduce liquidity, which in turn increases the bid-ask spread. For instance, if an option has a bid price of $2 and an ask price of $2.50, the bid-ask spread is 50 cents. This wider spread reflects the lower liquidity and higher volatility associated with options trading. Understanding these differences is important for traders. For stock traders, a narrow bid-ask spread means lower transaction costs and easier execution of trades. This is especially beneficial for those who frequently buy and sell stocks. For options traders, a wider bid-ask spread means higher transaction costs. It is essential to factor these costs into your trading strategies. Many options traders use limit orders to manage their entry points and minimize the impact of the spread. In summary, while both stocks and options have bid-ask spreads, options generally have wider spreads due to lower liquidity and higher volatility. This difference can significantly affect your trading strategies and costs, so it is vital to keep it in mind when trading.